main focus point concerns this topic: 8 common investing mistakes to avoid. And I love this kind of stepping back, thinking big picture, and reminding people and ingraining all of you the fundamentals of good money management, good investing, and good financial habits. Now, the number one is lacking a clear financial plan. I see this all the time. It's something we do for clients, is build out full financial plans, because it's really about identifying goals, your time horizons for your investments to hit those particular goals, because one goal might be 2 or 3 years away, another might be 20 or 30 years away, right? And then your risk styles, what type of risk should you be taking for each one of those buckets, depending on the time horizon. And when you don't have a roadmap, you can't really gauge whether you're headed in the right direction. I actually talked to a listener this morning about that, and he's a potential client of ours, and he said, sometimes I feel like I'm ahead of the game, I'm doing really well. Sometimes I'm kind of right at it. Sometimes I feel like I'm behind. And it's because he didn't really have a plan set out and understand what your financial life looks like in 5, 10, 15, 20 years based on your savings habits, your spending habits, your investment habits, etc. And so it's important to lay that out so you can make smart decisions with your investments. So without that, you're kind of lost. You're kind of wandering into the wilderness. And that's certainly something everybody should be dialing in for themselves, or at least having an advisor like us dialing that in. Number 2 is misunderstanding your risk tolerance. This is a big one that I see all the time, which is, the average person might think that because they're invested in blue chip dividend paying stocks, that they are being conservative, when it couldn't be farther from the truth. Right? All equities are aggressive. It's just a matter of shades of aggressiveness, right? Big blue chip dividend payers are on the lower end of the aggressiveness scale, but they're still aggressive. It's when you layer on other less risky assets like bonds, maybe adding in gold or precious metal exposure, things like that you start to create a diversified portfolio, running a covered call strategy, right? Lowering the overall risk while still owning equities, things like that can lower your overall risk that you're taking. And so this is why on our website, we have a risk questionnaire. It gives a score of 1 to 99. Better understand what actually means, right? Are you coming in at 30? I see this all the time. Their risk score comes in at 30 or 40 out of 100, and they think they're aggressive. In the reality, they're moderately conservative, for example, and vice versa. Sometimes they think they're conservative and their risk score comes in at 85. So understanding your true risk tolerance level is very important. And what that risk number does is it really dials in, okay, what are the true downturns that you're comfortable taking? Number 3 is failing to diversify and rebalance. Now, we know diversity is the simple the simple way to avoid one particular position to nerf your whole financial plan. Okay, so you want to make sure you avoid that, but rebalancing as well is equally as important, which is, years like last year, when maybe you're allocated a certain percentage to equities, certain percentage to bonds or cash. And now because equities did well, you are overweight equities, and having the wherewithal in the new year to rebalance, sell a little bit of that. And same thing with individual positions that did very, very well. Naturally, good times oftentimes lead to pullbacks, lead to reversions to the mean. And you don't want to be feeling that, especially when those positions become a big part of your portfolio. So making sure you're rebalancing. Number 4 is timing the market. We know that's very, very difficult. And the statistics show when you're out and during the best rallies in the market, you can drastically underperform. Those best rallies often come when the market is selling off. And so when you see pullbacks in the market, it's about having the appropriate risk in your portfolio. So those risk off scenarios in markets aren't forcing you to become more emotional. Okay. And what's number 5 is kind of similar to that, which is chasing performance. Instead of, making the wrong decision when the market is down, it's making the wrong decision when the market is up. It's, shifting money into strategies or asset categories that have done well recently, and you're trying to chase that and try to get that return because you heard your cousin or your neighbor get those returns, and you want to keep up with the Joneses. And we see that happening all the time. So targeting the appropriate risk kind of helps you avoid both timing the market and getting out at the wrong time when the market's down, as well as when certain asset classes are up. Then it's ignoring fees and expenses. So you have to be aware of the costs associated with your investments. We see this a lot with mutual funds, ETFs, that there are costs involved. You don't see them on a day-to-day basis, but they are being charged to you. So making sure those are reined in. And this is also something that an advisor can certainly help, and it may sound like you're paying a lot, but in reality, it's dialing in the right portfolio for you that can make up for whatever fee you might be paying them. And then the last one is not staying informed. Okay, there are economic trends, changes in tax laws, market developments that if you are on top of it, you can take advantage of opportunities. You can avoid risks as well. And this is why this is a difficult job. That's why we do it professionally, and why it's important to stay on top of this yourself and have the time and the data to do that. And if not, it's okay to hire an advisor as well. So don't be afraid to ask for help. And that's why we're here, or other advisors that are licensed that are out there.